Good evening, guys. I welcome you on behalf of ACCA Global and Scan School of Accountancy, Islamabad. I hope everybody is doing fine, doing in their best of health. And today we are going to conclude this webinar. This is the last day. I know the WhatsApp group, as promised, has not yet been made, but it will surely be made, hopefully. And I will be available for future correspondence through email and through that number if you guys have any issues. So I will be very happy helping you out with them. So far, this session has been very much interactive, and I am very happy that you people were up in asking the questions and getting the concepts that you wanted to clear as clear. And I believe that it has added into the knowledge bank of yours. Uh, First of all, we will be completing the question that we started yesterday. Further, we will be moving on to value-added tax, some share schemes, and other question that I will be working with Excel so that you have a better idea to use the Excel as well. And the last 15-20 minutes of the session will again be on those tips that are very crucial for the exam technique. So let's start the session. If there are any questions, you know the drill. You're more than welcome in writing the questions in the questions tab. I will be very happy to answer them. Okay, guys, the question was relating to the interaction of CGT and IHT. There was a guy, Akil, who required advice on capital gain tax and inheritance tax implications of gifting a warehouse to his daughter, Damia. He also requires advice on the tax consequences for the company in which he is a director and a shareholder of its disposal and acquisition of certain capital assets. So the first requirement was dealt with. We already were done with the first requirement in respect of the proposed gift of the warehouse on 1st October 2018, guys. It is of very prime importance that we highlight the relevant dates. Somehow, when the examiner says that calculate the tax implications for this particular year, and there are certain questions in which the planning of the person is actually not accounting for that particular transaction in that particular tax year. So just leaving that transaction is gaining you the marks. So we cannot ignore the dates. Dates are of very critical importance. We need to know for which tax year we are calculating the for which tax year we are working, and which transactions are being impacted in this tax year from a gain that has already been made in past or the gain that we are going to make in future. So the thing under question should be of prime importance, and everything that has already happened or that is going to happen, if it is going to impact your current scenario, current tax year, you have to consider it wisely and you have to look at the complete picture. So explain why capital gain tax relief will be available. In this case, we constructed the answer that the warehouse is a business asset which has been used by used throughout Akil's period of ownership, which is Akil's personal trading company. He is owning more than 5% of the ordinary share capital, and the Doni Damia is a UK resident. So these are the all prereqs of the gift reliefs availability that are being met. Hence, we say that the gift relief is available. See, there are only 3 to 4 lines written. In complete, if I combine all these lines, I am not getting more than 4 lines. It means that for 2 marks, I have written 4 lines. They are written in a very basic, simple English so that the expression I want to make is clear to the examiner. The basic trick, the basic idea here, I am again going to emphasize on that. When you are writing your question, when you are writing your answer, you have to prepare it in your mind and you have to take a reality check that whatever you have planned in your mind is actually in line with the requirement asked by the examiner. If it is in line with the examiner, then try to write in simple English. The simpler the English is, the more easy it will be for you to conclude the answer in less amount of words. The use of punctuation marks, the use of semicolons, commas, and sentences getting lengthy. When a sentence gets lengthy, it has potential of giving a meaning that was not intended. So it actually is not serving the case. So you have to be very much sure that you choose the right words and you put them up in plain, simple English. That's it. So what is the second requirement? The second requirement says explain with supporting calculation the effect of making a gift relief claim in respect of the warehouse on total CGT liabilities of Akhil and Damia, and the marks were 5. So there are supporting calculations and there is an explanation that is being required by the examiner from your side. We have gone through that Akhil and Damia, they both are resident and domiciled in the UK, both are the high rate taxpayers, both make disposals to fully use their annual exempt amount for each tax year. Now we have to link our requirement with that of the information given above. It says explain with supporting calculation the effect of making a gift relief. Now if we make a gift relief and if there is something that will be chargeable in this case is not going to be impacting any of my annual exempt amount because it has already been used by the concerned persons. So the differential calculation rule says that you don't engage in those things that are already clearly being said by the examiner. So annual exempt amount has been fully used. It is not going to feature in this calculation because the impact of this has already been guided by the examiner not to be included. I hope it makes sense for you guys. And let me just see the question. Okay, no questions as yet, but the questions are welcome. I really want that this last session gets more fruitful for you guys, and all the questions relating to the exam technique and everything else, the smaller points throughout the syllabus of P6 ATX UK version, you are more than welcome to ask. I will be there to answer you. And what about Akhil? He's a director and 55% shareholder in S Limited, that is a UK resident and trading company. Will give a warehouse building to his daughter Damia on 1st October 2018. The gift will be made on 1st October 2018, and it says that you have to analyze the impact for this transaction. Akhil's warehouse. Akhil acquired the warehouse on 1st July 2006. The cost was 62,000. The warehouse has fully owned by the company, and the current market value of the warehouse is 195,000. So it is simple calculation to get the answer or get the gain. Damia will use the warehouse solely. Now it says that explain with supporting calculation the effect of making gift relief claim in respect of warehouse on CGT liabilities of Akhil and Damia. So we are not just limiting ourselves to the impact on Damia. We are not just limiting our discussion for the impact on Akhil. The requirement says both. So the impact on the donor, the impact on the donee, and the calculations. For the donee, the calculation will be the base cost thing. For the donor, the calculation will be the gain that will be deferred. So 5 marks will be divided like that. Okay, Damia, the intended use is for her sole trader business, intends to retain and use the warehouse until she sells the business in 5 years time. So she is going to retain it for 5 years time, and if she retains it for 5 year times, it majorly satisfies the condition of entrepreneur at least, where the warehouse is anticipated to have increased in value. S Limited prepare. We are leaving the question till here because I guess the data we have gone through is enough to answer the below requirement worth 5 marks. Now, let's go to the solution. The effect of making a gift relief claim is that the gain of 133,000, it is a straightforward calculation. 195,000 is the market value at that time, 60,000 was 62,000 was the cost arising on the gift by Akil on 1st October 2018, and it will be deferred and deducted from the base cost of the warehouse for Damia. Accordingly, the chargeable gain will be reduced to nil. It says that he's gifting it out. It is not mentioned that any consideration is taken. We have discussed it yesterday's session that if the gift is outright, there is no consideration taken. The gain will be fully deferred. Thank you. Guys, give me a minute. Okay, the gain will be deferred in this case since this is an outright gift and the whole of the gain that is equivalent to 133,000 being deferred. And we made this rule that if the gain is deferred, that particular amount deferred will be deducted from the market value and the base cost will be calculated for the donee. So if the gift relief claim has not been made, Akil's capital gain, it is the explanation. Akil's capital gain of 133,000 would have been liable to CGT at the rate of 20%. Akil has already used his annual exempt amount for tax year 2018. ER relief is not available as Akil will not be selling his shares in S Limited, so the disposal of the warehouse will not qualify as the associated disposal for entrepreneur relief. So the CGT saved by opting for the gift relief will be 26,600. That is the amount of the gain into 20%. I hope this is clear for you guys. If there is any explanation required, you can please write it down in the question box. And if I see the attendees, all those my favorite guys like Ravi, Tommy, Evelyn, Fawad, Jawad, they all have shown. I'm really very, very thankful to all of you guys for bearing with me for these 5 days and coming every single day and giving your time and energy for me. I am very, very thankful to you guys. I hope these sessions actually add a lot in your exam journey and it proves out to be fruitful. So the questions are welcome, especially Ravi, Tommy, Fawad, Evelyn. Okay, so it is very simple. I will again dissect the requirement for you because this is the art of writing that is going to save you the time and will bring you the marks. It has said that supporting calculation is required and the supporting calculation you have seen, there is no lengthy calculation. I have not used any AE, I have not used anything. I have used my brain and I have tried to limit my answer to those points that are pretty much relevant to this. I hope it is very much clear for you. Now, when we come to Damia, when Damia sells her business in 5 years' time, she will realize a gain on the warehouse. This gain will be effectively increased by the amount of gift relief due to the reduction in the base cost in respect of the deferred gain. 133 was fully deferred, so the base cost would have been the market value minus the gain, and this would have increased the gain when Damia is going to sell the shares. However, provided the sales take place within 3 years of cessation, Damia will, just adding that assumption into it, that the date of disposal is within 3 years of date of cessation, Damia will be qualifying for ER relief and she will be disposing of the whole of her business which she has carried on throughout the year preceding the date of transfer. Therefore, Damia's CGT will increase by 133 into 10%. 133 into 10%, that is 13,300. The total tax saved as a result of the claim will be 13,300, 26,600 minus 13,300. So this is the total scenario without the option 26,600, but making an option, it will be 13,300, and we will be saving the equivalent amount in that respect. So Ravi, they are written in the handouts. You can go through them, please. If they are not clear, please let me know. I will be answering you again. Maybe on the voice note if it is not clear in this session, because we have spent handsome time on that. Maybe you missed out on that part of the session yesterday. But no worries, you can always ask me. I will be guiding you maybe on the WhatsApp, no worries at all, or on the email as well. Okay, so the next but I would rather encourage Tommy, maybe Evelyn, maybe Fawad, if you could write down the qualifying conditions of BADR for Ravi in the question box. I will be very much happy, and I will be thankful to you if you do that effort for me and Ravi. Please keep my words. Do that. Okay. The third one is advice on the availability of the business property relief for inheritance tax purposes if Akil dies before 1st October 2025. So in this case, the question is focusing on what? It says availability of the BPR for IHT purposes if Akil dies before 1st October 2025. Now we are going to consider we are not talking about the APR because there was no agricultural property involved here. It was business property. So that is why the business property relief is being concerned. The gift of the warehouse will qualify for the business property relief at the rate of 50% because Akil will have owned it for at least 2 years prior to the date of the gift, and immediately prior to the transfer it will have been used by S Limited, a company controlled by Akil. However, it is also necessary that Damia still owns the warehouse at the date of Akil's death. Remember, the withdrawal of BPR, we have to check the conditions that were being satisfied at the time of the lifetime transfer and at the time of the death tax. On both occasion of charges, we have to see for the conditions. If they are meeting, then BPR remains in place, but if it is not being met at the date of death, then we simply withdraw that. Okay. Accordingly, if Akil dies within next 5 years, while Damia is still in business, business property relief will then be available. But the business property relief will only be available after this if Damia reinvests the proceeds from the sale of warehouse in further qualifying asset within the 3 years of date of sale. It was clearly understood yesterday that if you dispose of and you buy back some other relevant property, maybe in a better form, maybe in an improved version, so it still qualifies for that. And this is it. This is the availability of the BPR in this case. And now let's go to the requirement of Spider Limited. Spider Limited prepares its accounts on 30th June each year, is owned by Akil 55% and Basir 45%. Basir is not connected to Akil and is neither a director nor an employee of Spydra. So anything for Basir relating to entrepreneur relief will not be applicable since he is not the director nor an employee. Okay, S Limited, the disposal of equipment. S Limited sold an item of its equipment for proceeds £20,000 on August 2018. The equipment had been purchased on 1st May 2012 for 65,000. The written down value of the company's main pool was nil at 30th June 2018. Rollover relief was claimed on the purchase of the equipment to defer a chargeable gain of 38,000. This is a very meaningful information. It says that the rollover relief has been already claimed, and the amount amount of the chargeable gain deferred was 38,000. S Limited will use the after tax proceeds from the sale of an item of fixed equipment to purchase a motorcycle which it will give to Basir. So the proceeds will be reinvested in something that will be given to Basir, who is not an employee, or the director of the company. Again, pretty useful information. Now, in light of this, we go through the requirement, and the requirement is worth 8 marks. So there might be some calculations, there might be some explanations, and so that we could earn these 8 marks. Explain with supporting calculations the amount of after-tax proceeds which will be available from the sale of fixed equipment and the tax consequences for both S Limited and Basset of the gift of motorcycle. What does it say? That you have to explain. It means that you have to make a narrative, you have to make a descriptive effort to explain the scenarios, and those descriptive efforts will be supported by the calculations. They will not be the primary calculations, they will only be the secondary supporting calculations. They will be supporting, but you have written in descriptive form. The amount of after tax proceeds, I have explained what are after tax proceeds. The impact of the transaction netted off with the amount of proceeds which will be available from the sale of the fixed equipment, and the resultant tax consequences for both the seller and the reinvested equipment, that is the motorcycle, for the basser. Now, moving to the answer. As the tax written down value of S Limited pool is nil, the disposal of the machine will not give rise to a balancing charge. The disposal of the machine will give rise to a balancing charge of 20,000. Balancing charge of 20,000. How does it implicate? It says that you have to relate it to what? You say that sold an item of fixed equipment for proceeds 20,000, and the value of the main pool was nil at that time. The value of pool is nil, but you are selling it off for 20,000. So it never says that actual things available in the pool were none. No, the tax written down value of that pool was nil. It may be because of anything. Maybe you have claimed it from quite a long time. That is not the concern here. But it says that it had practically some equipment that is written off in your books, and you are selling it off for 20,000. So it says that there will be a balancing charge. A balancing charge on pool can arise when the equipment exceeds the value of the total pool. Here the value of the total pool is 0 and it is sold for 20,000. So there will be a balancing charge of 20,000 pounds. I hope this is clear. This is a technical point relating to the capital allowances, and I tried to make it clear. So this will increase. That's good, Evelyn. Nice to see you in the session. This will increase Spider Limited taxable trading profit. Obviously, it's a balancing charge. Balancing charge will be adding into your profits, and this will be increasing your taxable total profits. A capital loss will not arise on the disposal of equipment because it qualified for capital allowances. Capital loss will not be arising because the capital allowances, that is the expense that has already been claimed. As the equipment is a depreciating asset for capital tax purposes, the chargeable gain of 38,000 which was deferred against the purchase of equipment will become chargeable on its disposal, which will also increase the Spira Limited's taxable total profit. Obviously, the reinvestments were in a depreciating asset, and we have read that the gain is unfrozen on the earlier of number one date was 10 years after the purchase. The second date was the date on which the asset ceases to be used in the business, or the date on which the asset is actually disposed of. Any date coming earlier will unfreeze the gain. So that gain, when unfreezed, will actually enhance the profits that will be taxed for the company. So in this case, it will be adding into your taxable total profit. So two things will be contributing: the gain that was already rolled over or deferred, and the balancing charge as well. The additional corporation tax arising as a result of this transaction will be the balancing charge plus the deferred gain being unfreezed, total of 38,000 plus 20,000 into 19% single rate of corporation tax 11020. There is a mistake done by the students that you are calculating for Spada Limited. The question in P6, they are simultaneously dealing with income tax of a person, maybe CGT, IST for the person, and some aspect for the company. So while answering, you should know, you should keep a very close eye on the part you are answering. Here you are answering the tax computation for the company, so you are using the relevant rate of the company. The after tax proceeds available to purchase motorcycle will be 8980, that is 20,000 minus 11020, the impact of tax netted off with the proceeds. So I hope this is pretty much clear to you, all of you guys. S Limited is a closed company as all of its share capital is owned by the two persons who are therefore participators in the company. As Besser is not a director or employee of S Limited, the gift to him of the motorcycle will be treated as a distribution. You see that the examiner has this much of leverage that it can test any of the area by just adding certain lines into the question. Now, the students who were able to identify that it is a closed company. What is a closed company? Can anybody tell me? Evelyn? Ravi? Come on, guys. I need to know what is a closed company. Please, come on. Hurry up. We don't have all day. Controlled by two or less. It's run by a family. Not just two, Ravi. Five or fewer. Tommy, where are you? I need the answer, man. Owned by the shareholders? Yes, that's it. Very well said. So mostly these are the small businesses run by the family, controlled by five or fewer shareholders or participators. That's it. Jack Ryan, welcome to the session, Ryan. Maybe Ryan or Jack. Thank you for the answer. You guys are very right. So not just identifying that it's a closed company, but you have written it out, and among those 8 marks, you are in a position that you have gained a decent marking here by identifying this thing, as Besser is not a director. Now, once you have identified that it is a closed company and the person who has been gifted or the person who has been gifted that motorcycle is not a director or employee, so he is purely a participator, a shareholder. So for a shareholder, it is treated as to be the distribution of income. So Besser will be treated as if it had received a dividend equal to the market value of the motorcycle in 2018-19. Accordingly, S Limited cannot deduct capital allowances or any other amount in respect of the motorcycle had it been an employee. So maybe the case would have been different, but now he is purely a participator, that is a shareholder. For shareholders, everything given to them is treated as a dividend, and it is not being dividend, it is not allowed for the company to subtract it from its taxable total profits or from its trading profits as a legit allowable expense. Yes, Jack Ryan, it's a disallowed expense. That is why it is not being covered. So guys, that is it. This was the question we started yesterday after going through the inheritance tax and CGT's reliefs, and we have seen that in order to construct a answer that is meaningful and for the okay, what Tommy is saying, Tommy is always coming up with some very good questions and very good. The company cannot claim, definitely, definitely, because it's a dividend. Dividend is a disallowed expense. You cannot claim any capital allowances on that. Agree, Tommy, you're right. So, guys, again, I am going to highlight certain points that are in this answer going to be the favorite of the examiner, and in next exam, if you are able to write such kind of questions, the appreciation will be for you, that the examiner will be writing in its report that some students were able to find and write this point. So I want that you guys are those students who are able to find and convert it into your expressions along with the calculations. You have seen that for these 8 marks, I have written these three, 8, 11, 12, 13, 14, not more than 22 lines. And in these 22 lines, I have not made the bulky calculations. No, not at all. I simply started explaining that what is the written down value of the pool, what is the disposal, and what will be the impact of it. Explain the balancing chart, that is 20,000. So calculation being done, 20,000 minus 0, 20,000 balance charge, I put it there. And I have simply explained that this is a balancing charge and this will be increasing my taxable total profits. Job one done. The second job, the capital loss will not arise on the disposal of the equipment because it qualified for the capital allowances, because the equipment is used by S Limited. So this equipment is a depreciating asset. It was qualifying for the capital allowances. So point two explained. Secondly, the gain that was deferred was of 38,000 when in case of a depreciating asset, among those three events, it unfreezes. When it is unfrozen, that 38,000 that was originally deferred has again came into play. So no calculations as yet. 20,000 this, 38,000 the other one. Simply explained in the explanation. Okay, moving on. The additional corporation tax, I simply added these two and I multiplied it with the relevant rate, and it is again within the narration being explained that the additional impact will be 11,020. The 20,000 here is already explained in the first paragraph, 38,000 being explained in the second paragraph. 19% is the rate that the examiner knows and is not expecting you to explain that. The total additional corporation taxes here 11,020 explained. Then the wording used was the after tax proceeds. So the after tax proceeds identified the proceeds, identified this corporation tax. So the tax impact netted with the proceeds equals to 8980, and these are what was expected by the examiner. The second part asked about the treatment if the motorcycle was to be given to Bassett, and we have explained that the background is what? The background is explained because without explaining the background, we cannot identify any close company, and we cannot identify the person who has been gifted is the shareholder only, because if we do not do that, the treatment will be vague. We cannot simply ascertain the treatment as long as we do not get ourselves cleared that the person is an employee under a shareholder or is just a shareholder. In this case, he was just a shareholder. We have explained that this is how things will be done. I hope everything is clear for you guys through this question. I'm going to the question section. Evelyn, Ravi, Fawad, is it clear to you guys? The technique used to do the question, all clear? Thank you very much. Okay, guys. Yes, need to try myself. Yes, good. Okay, somebody asked for the de minimis limit to be explained. So I will quickly go through the de minimis limit. Can anybody tell why we use to test the de minimis limits? Why this de minimis limit is in place by HMRC for VAT? Can anybody please? Tommy, again, I'm counting on you, man. For what? Why we incorporate the minimus limit? Is it for output VAT, for input VAT? Because some businesses are providing taxable as well as exempt services. Good. Where an individual deals in both taxable. Okay, understood. But mm, so that yes, Ryan, you are right. So that he can claim input credit on it. See, the question you have to understand. I said, for what this has been incorporated? This has been incorporated to recover irrecoverable input value added tax. So all those informations given initially by Fawad, by Jack, and by Ehtisham, it was correct. But had it been one mark question, it was simply asking you to recover the irrecoverable input VAT. That would have been ample. That would have been an ample answer. All the other details, they would never have been requested by the examiner. So you have to understand the question and you have to put up an answer. But still, you have time to prepare for the exam. This is not your exam, so no worries at all. But guys, one thing is for sure, that your preparation is pretty much decent as far as all of the participating students are concerned. You are able to question me on the topics we are covering. You are able to answer me on the questions that I ask you. So I guess, if you keep on trying, today is the 12th of November. You have ample time, like 20-25 days till examination, and these 25 days can be the make or break thing. But the current preparation I feel you guys have, you can score very good marks. Just have to focus on the time management, just have to focus on the technical areas being brought forward from TX examination, the questions we have attempted, the syllabus we have gone through, the examiner comments we have gone through. They have clearly been asking again and again and again that the students who were lacking the TX technical knowledge brought forward have flunked their paper. So I don't want any of you guys to simply leave that again. Please go through the TX course contents. They are the most critical parts. The application of them will be changed. You will no more be asked for the calculations that you did in F6 examination, but you will be expected to apply the knowledge from those areas into the scenarios given in the examination in your words, as a tax manager or a tax partner or someone who is more than a tax trainee or a tax junior. I hope you won't be leaving TX now. That's good. Okay, so the de minimis limit deals with the irrecoverable input VAT, and the de minimis limits, we have this little information. Kaplan ATX book help to tackle the F6 course. Yes. We have the expandable text. They have added a lot in that. And if still you feel that there is something left, you can always go to the ACCA website. You can access the technical articles of F6 and P6. They will be equally very much helpful to you. Further, one more thing that I would add here is, please go through the examiner comments of previous at least 4 attempts. If you go through the examiner comments of 4 attempts, I have gone through them, and in these sessions I explained each of that point that he has raised. But since it is not a face-to-face interaction, you might not have capitalized on everything that I said. You are kindly requested to go through the technical articles and examiner comments relating to P6. You will be getting a very good idea how to pass the paper, and this will be the cherry on the top of this session, and this will be very much helpful to you. Okay guys, moving on to the de minimis limits. The de minimis limits are, let me just shrink it out. Okay, the total input VAT less than 625 per month, and exempt supplies are less than 50% of the total supply. Now, this is not something that is very difficult to understand. You just have to uh, add some specific things in your mind. Two things for the first case. What are them? If you say there are some exempt supplies and there are total supplies, so the exempt supplies will be the part of the total supplies as well. So they say that if the total input VAT is this way per month and exempt supplies are less than 50% of the total supplies, you take out the total supplies, you multiply it by 50%, you get the limit. And if your exempt supplies are less than 50% and this amount is there, then the first test of de minimis limit is satisfied. On the second thing, your total input VAT less input VAT directly related to the taxable supplies. Now you have to highlight your taxable supplies. And when you highlight your taxable supplies, you calculate the VAT directly related to those taxable supplies, and then the total input VAT is subtracted. And if it is in this pattern, and exempt supplies are less than the 50% of the total supplies as we discussed in the above case, then the second test will be satisfied as well. So there is no need to just memorize it, try to understand it. The first test is again used in the second test, along with the difference between the total input VAT less the input VAT directly related to the taxable supply. So when the first test is clear to you, the second test is basically the extension of the first step. In everything you have done in first step is coupled with another thing, that is total input VAT less the input VAT directly relatable to the taxable supplies. Okay. Then the last one is input VAT related to exempt supplies is in this pattern, and input VAT relating to exempt supplies less than 50% of the total input VAT. So the total input VAT you have calculated, you multiply it by this figure to calculate the limit, and the input VAT relating to the exempt supplies comparison in comparison to that limit is following this pattern. The third point, the third limit of de minimis limit, the third test of the de minimis limit will be satisfied, and you could recover your input VAT in that fashion. It is not very technical, it is very simple. You just need to know what the exempt supplies are, what the total supplies are, what percentage is to be applied to exempt supplies or total supplies, in what version you are going to use the VAT that is related to the that is directly related to taxable supplies. And all these rules will be very much on your fingertips. Annual test is the business can apply the de minimis limit once a year rather than every return period. All of you guys will be aware that there are VAT periods. You are not going to apply this test in every period, but you could simply apply it once a year. If it is met, the business was in de minimis limit in the previous year, and the annual test is applied consistently throughout the current year, and the input VAT for the current year is not expected to exceed 1 million. So the overall limit for this is you are not exceeding 1 million at the end of the accounting period. So this test has been applied for once a period. At the end of the accounting period, this will be reviewed again based on the year as a whole, and if there is any adjustment that is to be required, that will be passed, and your de minimis limit status will be based upon that very thing. Okay, there are some questions. Kaplan ATX book. I have told you this. Good evening. Is there a WhatsApp group for this session? Please, would love to join, guys. Once we conclude the session today, every person who has texted me on my WhatsApp, I will be making a group for you, and then you could ask me the questions that you wanted to ask but was not able to ask. Okay, can you take an example? Yes, Tommy. Let me see if there is some question. I will be applying it to that if the time is ample. I hope there is a question that we will try to figure it out. Okay. So guys, value-added tax is done. Now the third thing, the most important thing, and something we could say that features in examination was the share schemes. Who was most interested in these share schemes? Questions. So please share your number. Fawad, I have shared it. I will be sharing it again. 0092. I have shared it. Sure, Sola. Sorry if I don't pronounce your name correctly, because it might be my first time pronouncing your name. So please pardon if it is not correctly pronounced. Yeah, sure. Had you been in the first session, I would have been calling your name again and again, but unfortunately, this is the last session. So I will be calling you Bolu. Thank you, Bolu, for joining in, and I hope you get out some beneficial input from these sessions. Okay, guys. So share schemes we are going to discuss. I will be quickly going through them, but you know that if you analyze any past exam paper, these schemes are Jack, they will be shared with you with the guys who have already been subscribed for this session. I guess the ACCA, you could simply email on you could simply ask on an email that you require the link for the audio recordings or maybe the video recordings, and they will simply give you. Bolu, just give me a text on my number I've shared, so I will be adding you into the group. Okay. So pleasure is all mine, Jack. So guys, these share schemes, I haven't seen any paper in which they are totally ignored. If at least they are at least asked for 2 marks, 3 marks, and if at the most they are even gone for 8 marks, 9 marks. So the share schemes are relatively easy marks to score. 3 marks, I I am unable to see your number, Jack. I'm writing it again for you. Good, you please. Gagandeep, there you go, buddy. Okay, guys, hold your questions for 5-7 minutes so that I could go through the share schemes, and we will be back to the question session again. The today's session I really want is mainly based upon the question session, so that if there are any difficulties for you relating to any topic or any specific things, I could answer that. 1 hour is almost gone. We are left with the little time. So I'll quickly go through the share schemes, and then we will be moving to your questions again. And there will be a question that I have attempted for you on Excel. I will be guiding you how to do that on Excel as well. Okay, guys, I'm closing the window for the questions. Let's go through the share schemes. I have opted for these 4 schemes. I believe that was asked by Ravi and some other students as well. Okay, Ji. Number one is share incentive plan. So you know that what is a share incentive? I'm not talking about any plans. What are the share incentives? If you are being given the liberty to subscribe for some shares at some discounts, at something less than a little market value, that will be your incentive. And in these cases, a raise of hand is here. Okay. So the income tax advantage from SIP is when you receive them, pay no income tax or NIC if you hold the shares for more than 5 years. So the basic minimum holding period is 5 years, and if you have them for 5 years, no income tax or NIC is being paid on the shares had in share incentive plans. Capital gains tax, when you sell these shares, when you remove the shares from the plan, the cost of the shares is equal to the market value. Nothing has been done prior to that, so the market value will be the consideration. When removed, there will be no capital gains tax. How to get the tax advantage treatment is like share must be offered to all employees. See, these are the conditions that are to be satisfied. If they are not to be satisfied, they are not satisfied, you will not be getting any incentive out of everything you do in these schemes. So the conditions, the qualifying conditions are very much necessary to be followed. Number one condition for SIP is shares must be offered to all employees who have been working in the company for more than 18 months. You cannot be selective because HMRC says that if it is a plan, then it should be given to every person who actually wants to subscribe. You cannot be selective. You cannot simply be rewarding the persons you want to reward. I hope it is clear. The second one is maximum value of shares that employer can give to each employee each tax year cannot exceed 3,600. Maximum amount given by the employer to every employee every year cannot exceed 3,600. If any person gets it more than 3,600, it is going to compromise. Shares must be held for 5 years, and the minimum period, as mentioned already, is 5 years. Consequences of withdrawing the shares before 5 years from SIP. If you do that in less than 3 years, income tax and NIC consequences will be the income tax and class 1 primary NIC are payable in the tax year of withdrawal based on the market value. When you will be doing the withdrawals, the market value will be taken, and on that market value, the relevant income tax rates and class 1 primary NIC will be applicable. Withdrawing shares in more than 3 years but less than 5 years. So you have gone past 3 years, but the 5 year mark is not yet completed. Then income tax and class 1 primary NICs are payable in the tax year of withdrawal based on the lower off. It remains the same, but an additional point of being lower off is being added. Market value when first awarded and market value when withdrawn from SIP. Whichever is lower is going to be taken just to add some facilitation that you kept it for a reasonable period of time with you. And capital gains tax, for capital gains tax implications, the base cost of the share is the market value at the time they are withdrawn from the share incentive plan. When you withdraw the shares out of the investment incentive plan, at that time the prevailing market value will be the base cost, and this will be used for the gains. Ravi, helpful or not? Don't say that, not please. Still not 100%, but helpful. Okay. Okay, let me share a shortcut with you. That this is a simple thing that I could do for you. What you have to do for a for any share scheme, that is the basic thing you need to know is the qualifying conditions. Okay, Ravi, what you have to do is you have to be very much sure what qualifying conditions are. There are in some cases three, there are some in some cases there are four, there in some cases five, but you have to remember at least three critical qualifying conditions. Once they are known to you, it is very simple that then you could apply the relevant rates. And how many rates are going to be applied? See, the shares are going to give you two kind of incomes. Number one is the dividends, and what tax you apply on them? It's the income tax. And the other one is if you dispose the shares, you apply capital gains tax on it. So again, making your mind clear about either the income tax will be applied or the CGT will be applied. While retaining the shares, the tax concern will be income tax, and when we will be disposing of the shares, this is the basic understanding that we are concerned with capital gains tax. So considering all these things in mind, you could simply go and note the consequences. If you use for the qualifying period, no tax is involved, and like these 3 points, I guess it will be helpful for you. Then we see company share options plans, we call it CSOP. A share option is an offer to an employee of a right to purchase shares at a future date at a predetermined fixed price, which is set at the time the offer is made. Can anybody tell me why the right issue is issued to the? This is not relevant, exactly relevant here, but I really want to know that if you guys know that, why the right issue is given to the existing shareholders. Why we cannot simply go to the market and issue new shares? Why is there need to make an offer to the existing shareholders for the right issues? I'm waiting for the answers. Tommy, not to dilute, good to give them a preference so that do not dilute. Evelyn, very nice. Providing existing shareholders the share prices go in the market cheaper and the Shashini Nankala. That's great. All of these questions are very much relevant. All of these answers are very much relevant and on point. The best answer here, I could say, is of Tommy and Evelyn, that the dilution of shareholding, because if the company is already positioned on 51% and 49%, and by mere issue of this right thing, it could actually change the management of the company. So the existing shareholders are being offered, and if they are not considering themselves interested, then if any change happens, there is no point of going against it. But as far as the current condition is concerned, you have to offer them to the existing shareholders. Good, everybody, and thank you very much for answering. You people are awesome. So the predetermined fixed price is usually below the market value of the shares at that time. Obviously, if the predetermined price is more than the market value or is equal to the market value, there is no lucrativeness in that. And why a person would be going for that if you could get the same thing from the market at the same price? Why will you be going for this option? They are definitely at some fixed price, but it is usually lower than the market value. The taxation consequences for share options depend on whether or not they are approved by HMRC as follows. The approval of HMRC is very much critical here. The tax advantage share option schemes are the company share option plan, the enterprise management incentive share option schemes, and SAE save as you earn option scheme. So there are different schemes in this case. The income tax implications here on grant: when these options are granted, you do not need to pay. Again, the point on which they are being issued, the point they are on which they are being exercised, the point on which they are being disposed, these are the critical points. These are the critical timing of the of a particular action that you are taking. So we could see that on the grant of such options, you don't have to pay any income tax or NICs, because on the grant of the options, you are not actually materializing any cash benefit out of it. It is a benefit, but it is in your financial books that you could see that if I do it, if I dispose it, or if I look it in the financial terms, there is a financial benefit being embedded, but you have not cashed it yet. If you have not cashed it, if there is nothing significant in your hand in the form of cash, you won't be paying any taxes. So on grant, no income tax or NIC being applied. On exercise, when you exercise it, you pay income tax and NIC. If the market value at the grant date is more than the exercise price, then the difference will be the taxable benefit, because the price you are exercising, for example, is 2 and the market value is 3. So the benefit to you is pretty much clear that at that very time, that option that you are being exercising is rupee 1 or pound 1 more than the exercise rate. That is the actual benefit you are being receiving. So it is taxable there. For CGT, when you sell the shares, you pay CGT, and CGT is calculated market value at the sale date minus market value at the grant date. Because if there is any difference, it has already been adjusted or being taxed, and it says that you will straight away be taking the differential of the market value at the sale date minus market value at the grant date into CGT tax rate, whatever rate is being applicable, you can actually use it to calculate the CGT related. There are conditions that the company and employee must satisfy for the share options to get tax advantage treatment. Again, as I have stressed enough on that, without the qualifying conditions, there will be no relief given. What are the qualifying conditions? The company needs to satisfy, number one is gross assets must not exceed 30 mil pounds. So the gross assets of the company, they must not be exceeding 30 million at any time. Plus the employees in the company must not exceed 250. It is a company that is having maximum employees up to 250 in number. Maximum value of share options issued must not exceed 3 million pounds. So the share option issued at any time are not exceeding 3 million pounds. I hope these three conditions are clear, and these three conditions are to be satisfied by the company. But in this case, company is offering the options, and the options are being utilized by the employees. And for the employees, the conditions to be satisfied, the conditions they have to satisfy are: the maximum value of share option that can be issued is 30,000 pounds per employee. So an employee cannot exceed 30,000 pounds for such share options. That is number one for the employee. The number two for the employee is that must have ownership is less than 30% of the shares. An employee cannot be having more than 30% of the shares. If it is more than 30% of the shares, the employee might be some a critical portion or critical part in order to make or break any management kind of thing. So these are the conditions that have been explained for this. The third one here is EMIS, which we say EMIs. There are conditions that the company and the employee must satisfy for share options to get tax advantage treatment. The conditions to satisfy by the company are: gross assets must not again exceed 30 million. Company in employees in the company must not exceed 250,000. Maximum value again must not exceed 3 million pounds. Conditions for the employee, there will be difference here, that employee must work for at least 25 hours per week. So they are working employees, plus employees must own less than 30% of the shares in the company. Same as that, maximum value of share options per employee is 250,000. In the above case, it was 30,000. So here the person in value, in the above case, the percentage was still 30%, but the value was restricted to 30,000. per employee. But here it says per employee, again it remains less than 30%, but the value in pounds can be 50,000. So obviously the base figure in this case will be much higher than the above. Ravi, are you with me? Getting the better idea? Great, buddy. This effort is for you guys. Saying related share option, savings related share option schemes. These are the SAYs. What is the treatment of the pay by say? I always remember pay thing. So can anybody tell me if Tommy, Ravi, Fawad, Evelyn, we have two Evelyns with us. The second Evelyn who's not much active, can you please tell what is the treatment of pay? Yes, you're right. So pay as you earn from every salary month. What is the treatment in our calculations? We subtract it from the income tax liability to reach out to our income tax payable. These are the tax credits. Okay, very nice. Jawad Khan. Thank you, Jawad. Thank you for your answer. Much appreciated, brother. So we go to, let me just, okay, for the questions. Okay, no questions yet. Okay, what are the says? Employees are granted an option to buy shares and then save through a tax-free saving scheme in order to raise funds to exercise the option. There is a favorable tax treatment for share option schemes that are linked to SAE contract. How does the scheme operate? Each employee pays a minimum of £5 per month and a maximum of £500 per month into a SAE scheme for a period of 3 to 5 years. So you are accumulating your money as per the amount you can set aside. It can either be at least £5 or at most £500 per month per employee for a period up to 3 or 5. So the basic minimum period is 3 and the maximum period as per this line may be 5 years. Interest on the scheme is exempt from the income tax. So simply said that the interest on such scheme will be exempt from income tax. Any interest coming out of it will not be attracting any income tax. At the end of the scheme, the money. Okay, can anybody tell me if I am hypothetically assuming that the interest from such scheme is £1,000 and a person is a high rate taxpayer, will it be consuming the nil rate band available to that person? How much is the nil rate band for savings income for a high rate person? 500 limit. Tommy, can you please enlighten Ravi on this? Is he right? Limit is 500, agreed Ravi, but the exempt income will consume the nil rate band or not? This is the question. No, it won't. Very good, Ravi. You're right. Since it is an exempt income, nil rate band is something that is chargeable at the rate of 0%. But if you say that it is exempt, it won't be consuming the nil rate band. Fair enough. Can anybody tell me what is the starting rate? Can anybody tell me what is the starting rate on savings income and why it is applied just on saving incomes? For which facilitation you want to create for those people? Waiting for the answers. Come on, guys. Tommy, your answer is required, buddy. These are the nil rate bands, Ravi. I am talking about the starting rate. Yes, Kate. Kate, mess up. It is 5,000 starting rate. It is taxed at which percentage? Okay, you are right. 0% on which income? Yes, Evelyn, it's 0% on which income? Saving incomes, if non-taxable. Itisham says if yes, Itisham. Good. If non-taxable income, not taxable first income. Can anybody write down the reason? If no non-saving income, yes, very right. Itisham and Evelyn on point. The rest of you as well. Kate as well, and Joseni also. Yes, guys, starting rate is considered to be given because you could see that if your earned income or your non-saving income is within 5,000, it means that yes, Chuseni, you're right. Let me finish my sentence so that those who do not know get a clear idea. It is like for the people whose earned income or non-saving income is within 5,000. It means that by working out, by consuming the resources present in the economy, they are not able to generate enough of the income that is exceeding 5,000, but they have somehow managed to place their funds under some investments on which they are earning interest. So HMRC considers to support them since they are not getting the earned income and they are giving them the privilege to tax their saving income if it is falling within first 5,000 of the taxable income. By this, they are going to facilitate those persons who are not able to generate much of their earned income. They may be widows who are not able to work, or there may be some people with disabilities who are not able to work, or if they are working, they are not being paid much to meet both their ends. So this was the logical reasoning of HMRC for giving this extra advantage to the persons. Okay, I hope this is clear. So coupling it up with the personal allowance, the nil rate bands available to saving and the dividend income, this can be very much helpful for the persons who are not able to earn much. Great. So it says that interest on the scheme is exempt from income tax. At the end of the scheme, the money can be used to exercise the share options, or the employee may just withdraw the money on their own. Simple as that. When the scheme ends, the money accumulated as per your accumulation, either you were putting minimum 5%, £5 per month, or maybe maximum of £500 per month, the money accumulated will be used to exercise the share option, or simply you could withdraw the money that you have accumulated. Income tax and NIC implications are none when the options are granted. No income tax or NICs are applicable on the grant of the options and on the exercise of the options. And for the capital gains tax implications, when such shares are disposed, there may be capital gain for them, and that would obviously be considered. Conditions for say scheme are the amount saved must be at least 5 per month but cannot exceed 500, the same as we have gone through. The saving contract must be for at least 3 or 5 years. Again, it is responsive or in continuation to what we have gone through above. The scheme must be available to all employees who have worked for the specified qualifying period, which cannot exceed 5 years. Again, you just cannot reward to the employees you want to reward. You have to give them without any discriminations. You have to follow the rules of uniformity and equality to ensure that every employee, see, one end is £5, the other end is £500. So even the PNs, even the very smaller contributors to the organization and the high end contributors to the organizations can plan the saving for them. The exercise price must be at least 80% of the shares market value at the time when the option is exercised. So if the market value is 10, that exercise price must be at least 80%, at least 8 at that time. So these are the share schemes that we've gone through. If there are any problems still, you can always text me or email me. I will be very much happy answering your questions. Guys, this is it from my side on the shares schemes, and we have this question that we will be attempting for corporation tax, and I saved. Next, we will be doing this question. I have sorted it out on Excel for you guys so that I could quickly go through the question and the solution of it. We are remaining time around. We have to conclude our session in 90 minutes from now, and we need to take a break as well in that. So I will be quickly going through the question and its solution. I have done it earlier for you. So guys, again, I would urge you, if there are any questions, if there are some specific pain points from any area of the syllabus, you could please ask me, and I will be very, very, very happy to answer you. Okay, guys. Let's go through this question. Let's go through the introductory paragraph and the requirements. Then we could have a break of 15-20 minutes. Then we will come back and sort out this question. We will be quickly sorting out the question. Then we will again be focusing on some exam techniques, some exam points. And meanwhile, I will be answering every question that you will be asking me, provided it could be answerable. How we get professional marks. Itisham, I told this in the first session. You will be getting the videos, but while attempting this question, I will be enlightening on that. How can we get the professional and ethical marks related to ethics? The most easy marks in the paper are the professional marks plus the marks related to the ethics. The professional marks you can get by writing a report. If it is said that you write a report, if it is said that you write a memo, you follow the requirement of the question. You do whatever you were directed to do by the examiner, you easily get those professional marks. And for the ethical marks, you have to understand the scenario and you have to go through the objectives of ethics that are being compromised in that particular scenario. You have to refer to that scenario, and you could say that these pillars are being compromised, or these pillars are being under question, and either they can be eliminated simply, or if not eliminated, we could at least place some safeguards. And for each of the problem, there will be a separate safeguard that could be identified, and you will be identifying those safeguards, and then you could easily be getting those ethical marks. I hope it's clear. So now, your manager has received a letter from Meta, the owner and the managing director of P Limited, a client of your firm extracts from the letter together with extracts from an email from your manager detailing the work you require to do are set as below. Again, like the questions we attempted, one question we already did yesterday, that was the same style question in which your manager received a letter. In that, it was a meeting with the client. Now you're receiving a letter from your client, that is the owner and the managing director of some corporation, that is a client of your firm. The now manager is not writing anything in this, it is giving you the extract from the letter that was written by the client to your manager. The manager is going to share the extracts of that letter to you together with the extracts from an email from your manager detailing the work you are required to do. So the data source here is the letter from the managing director of the company plus the directions by your manager will be given in the accompanying email from your manager for you. I hope this is clear to you guys. The opening paragraph. First, we go through the opening paragraph, then we go through the requirements, what is required. Question is worth 25 marks. You could see the first part is worth 4 marks. The second part, so we will be having enough details of Q limited since it is worth 15 marks, and for R limited we have 6 marks. It says that carry the work required as requested by the manager in email. The following marks are available. Again, the requirement. This is the typical style of asking a question that you are required, that the requirement is shown separately with the marks available against every requirement, and it is referring to the email of the manager. Okay, what the email of the manager says. Sorry, guys. Let me just see from where the email begins. Yes, the extract from the email. I don't know what happened. The computer has just gone slow. Okay, guys, let's have a break first. We will be back at 10:20. Meanwhile, I fixed this document. I don't know what happened to it. It is not coming as I wanted. Okay, I'll be fixing it and see you in good 20 minutes. Thank you. So guys, I hope you all are back, and some of you guys may have gone through the question in this break time. Okay, so guys, we were going to go through the extract from the email of the manager who was going to instruct us what we need to require in this specific question. And it says that for P limited, first of all, we are going through what for P limited is, what for Q limited is, what for R limited is, and then we will go back to the main question, and then we will be sorting it out as per the requirements given. Meta owns the whole of the ordinary share capital of P Limited, which is an unquoted trading company. It is an unquoted, it is a trading company, and it is also a personal company. More than 5% shares of the company are being held. Basically, it's a wholly owned company for him. Meta began trading as an unincorporated business on 1st June 2012. On 1st April 2015, when the assets of a business were worth 120,000, she incorporated her business by selling all of the net assets to be limited in exchange of 10,000 ordinary shares. This sale resulted in total chargeable gains of 3,740 pounds, all of which were relieved by incorporation relief. P Limited prepares 31st March accounts till 31st March each year. It does not own any assets other than those which are used in its trade. Fairly simple question. Uh, as we talk about the P Limited, the simple approach is required. We are given that the assets of the business were worth 120,000, and it was a total exchange. The sale was for against the exchange for 10,000 ordinary shares, and the total gain out of this sale was 37,400. So the amount of gain has already been calculated. And for the Q Limited will be a small enterprise for the purpose of the additional tax relief for the expenditure on research and development. Here the concern is related to CGT, and here the concern is related to the enhanced expenditure on research and development that is given for small and medium enterprises and large companies. We know that there are different rules being applicable on the large companies and different rules being applicable on the small and medium-sized enterprises. So it should be mentioned, and it is mentioned that it is a small enterprise, so it will be qualifying for the additional 130% of the qualifying relief. That is total to 30% of the amounts being used in such genre will be taken for tax savings. I have already established that the research to be carried out by Q Limited will qualify for this relief. See, this has been established by the manager for you. You do not need to waste time on that. For looking for the qualifying conditions, Q Limited will not surrender any part of loss in return for the cash refund from HMRC. You people know that where such loss arises, where the loss from these qualifying expenditures arises, you may surrender the loss and you get a cashback of 14.1%. But it is clearly stated that there will be no cashback opted by the Q Limited. For R Limited has not been R Limited has not made an election to exempt the profits of its overseas permanent establishment from UK tax. The rate of corporation tax in the country of T is 14%. Other than that, the tax system in T is the same as in that of the UK, and there is no double tax treaty already between UK and Tirona. So these are very important notes that is given in the email of the manager, and he is saying you, he is directing you to carry out the following work. First thing, he is asking you to sale of 4,000 shares in P Limited on 1st May 2020. Calculate Meta's capital gains tax liability in respect of this proposed sale to NED, assuming the available reliefs will be claimed. So all the reliefs that are available in this sale of 4,000 will be accounted for. Mita resident in the UK, you should assume that she will be a high rate taxpayer in 2021, and the CGT annual exempt will not be available to her. Again, the manager has conducted all those research work and he is clearly giving you the instructions what to look at and what not to look at. For things you should not looking at, you should not be looking at are the things that are actually going to save you time and they're actually going to get you the marks for not going after things which are not required. Okay, that is the first requirement. The second requirement in case of Q limited, that was the major that part was of the major marks. Before going to that, we go for the, but let's finish this first. For Q limited, what you have to do, explain the tax reduction which will be available to Q limited in respect of scientific research cost of 102 to be incurred in the year ending 31st March 2021. There are some research costs and they are of 102,000 pounds. Explain the tax treatment of the proposed purchase of Q of the clock brand and intangible fixed asset for 35,000. Now you see that the intangible asset treatment is done as in line with the accounting treatment, or maybe it is impaired at the fixed rate of 4%. So there might be the case when we go through the details of this question. Calculate the amended budgeted tax adjusted trading loss for Q limited for the year ending 31st March 2021, taking into the account explanations requested above. Explain how the Q limited amended budget trading loss will be available for the use of P limited. So the group of companies is also being involved. Value added tax implications are also to be explained of Q limited purchasing advice from the overseas supplier rather than one based in UK. So what will be the implications if you choose an overseas supply, or what are the implications if you choose an UK based supplier? For R limited, what you have to do is you have to explain why the profits of R limited are being subject to the corporation tax. Calculate the R limited expected UK corporation tax liability for the year ending 31st March 2021 based on the information available, and discuss the advantages and disadvantages of R limited, making an election to exempt the profits of its permanent establishment in Tirona from the UK tax. So it is a complete package from corporation tax point of view, where it is trying to test each point that may be related to CGT, that may be related to any research expenditure or some value added tax aspects, and the aspects of the overseas as well. So all of these things are being tested in this question. Now going to the main body of the question, we have seen what we have to do for Q limited, for R limited, and for P limited. Now let's go through this detail that has been shared by us from the extract of the letter from Meta. Sale of 4,000 ordinary shares. What happened in this case on 1st May 2020? I am going to sell 4,000 shares in P Limited to my brother. Okay, there is some connection established. It is between the connected persons. The brother name is Ned. I note from the work you have already done that the current market value of these shares is £260,000. However, because I'm keen to get NED involved, I have agreed the price of 200,000. See, she's going to sell 4,000 shares to her brother. Current market value is 260, and the price going to be charged is 200,000. So it is an undervalue sale. Now we have to find the cost. What is the cost of it, so that we could see how the gift relief will come into play. Ned, who is UK resident, will sign up the claim for capital gains tax relief in respect of the sale. It means that any gain that is going to pertain to Meta will be transferred to Ned. Okay. Okay, guys, if you could see that for P Limited, it says that the business was worthing 120,000 pounds. I just wanted to make it clear for you so that you could see that the market value is the 260,000. We all know that if there is a sale between connected persons, we will always, or we will be considering higher of the actual sale proceeds or the market value. Actual sale proceeds here, the consideration is 200,000. That will not be relevant. We will be taking 260,000 since it is a sale between connected persons. The market value of the assets of P Limited is 120,000, so that we are considering it as a cost. Less incorporation relief. Incorporation relief we get out as 37,400. I hope the screen is clear. Okay, no questions here. Okay. So this resulted in total chargeable gains of 37,400, which were relieved under incorporation relief. So here is the thing. Less incorporation relief. This it is clear that relief of 37,400 has been applied. With that, the gain is 82,600. And while using Excel, you can easily be uh, adding an internal column and then an outer column. The outer column will be representing the outer version of the calculation. Some smaller calculations are to be adjusted in the inner column, like here. The market value of the assets were 120,000, incorporation relief was 37,400. So we could see that this is the smaller calculation being done under the smaller under the internal column. Then we will be transferring this to the outer column, and we have seen that the amount, if you remember the gift relief rules, we said that the amount more than the original cost will be the amount chargeable for gift reliefs. See, if you could remember, in this case, the amount above that is 166,000 among all the gains. If this is chargeable, the rest will be the gain holdover under gift relief that we will be holding. And this is something, if we calculate for NED, the impact of this 60,000, it will be actually being subtracted from the market value of the assets being transferred to him. And we could easily see that all the conditions of entrepreneur are being met. Entrepreneur relief are being met. So the amount chargeable here is 166,960, and we will simply be multiplying it with 10% to get our entrepreneur relief in this particular scenario. If there is any question, you are more than welcome. I will re-explain it. You have to simply add an outer column and an inner column, some smaller calculations that can be sorted out in the inner column, and the results could be taken out to the outer main column, where you could express your calculations, and you could write the, you could apply your main rates and conclude it for yourself. Now another thing you need to know is you have to put on these pound sign. You cannot simply ignore them. They are also very important while working out, and you have to also make sure that if there is any explanation points, you should explain them. Now in Excel, everything is clear here in the description I have provided, so I don't need to provide any extra notes. But if there are any extra notes that would have been used, I would be adding the static and adding all those notes here, so that the examiner, while seeing the calculation, could easily would have referred to the mindset I was having while attempting the question and providing this answer to the examiner. I hope this is clear. for B. It says that P is clear now. I am again telling you that the assets, it was given 120,000. She incorporated her business for the exchange for 10,000 ordinary shares. They resulted in gains of 37,400. So the gains were given already that were covered in incorporation relief. It says that all of them were relieved under incorporation relief. So among 120,000, this was relieved under incorporation relief as stated by the examiner. We are not calculating any incorporation relief here, and the rest of the gain was left with. Okay, now for Q Limited, I hope it is clear. Q Limited will be a smaller enterprise. What are you expected to do with Q Limited? Explain the tax deduction which will be available to Q Limited in respect of scientific research cost of 102 to be incurred in year ending 31st March 2021. First thing you have to do is to establish which kind of company it is. So we could easily see that it is a smaller company. So now we are going to explain each one of the relevant point that could be impacted here. The equipment and computer hardware will qualify for 100% capital allowance. It is not simply asking you to provide the answer for the research cost. It is saying that explain the tax deduction which will be available for Q Limited in respect of scientific research cost of 102 to be incurred. This is number one. Number two is explain the tax treatment for the proposed purchase of the clock brand, that is an intangible fixed asset, for 35,000. Calculate the amended budgeted tax adjusted trading profit for Q Limited for year ending 31st March 2021, taking into the accounts explanation requested above. So all the above things are to be calculated and their impact has to be posted in the budgeted tax adjusting trading losses, and we have to explain based on the above calculation that how much Q Limited amended budgeted trading loss will be available by its group company P Limited, and whether value added tax implication for Q Limited will be, what will be them if an overseas supplier is rather than the UK supplier is considered. Now to the answer, the equipment and computer hardware will qualify for 100% capital allowance as capital expenditure incurred for the purpose of research and development. Accordingly, the total cost incurred of 102,000 pounds will be deductible for the purpose of corporation tax. Now keep it simple, keep it steady. First, to 102,000 is the normal deductible expense. So we say it is a normal deductible expense and we qualify it. Then as Q Limited is a smaller enterprise, first we post the nominal impact, that is it is an allowed expense, it is deducted. Then we go for the super normal expense that is being granted, and it says that 130%, as Q Limited will be a smaller enterprise for the research and development purpose, certain categories of revenue expenditure which will be directly related to research and development activities will qualify for an additional 130% deduction when calculating the company's company's taxable trading income. This additional deduction is not available in respect of the capital expenditure on the rental cost. There it is in the question being told us there are some rental costs, and we know that for rental costs only 65% of such amounts qualify for the additional deduction. So there is an additional deduction of 130%. Some of the components will straight away qualify for that additional deduction, but for some components we first have to calculate the 65% amount and then we could move on. So the calculation of the tax deductions available: total research costs are 102,000, less equipment and hardware is 27,500, that is a capital expenditure. Rent as communicated in the exam is 17,400. Staff cost, that is the rental cost here, they were 7,000. So multiplying it by 35,000 to 450, amount qualifying for additional cost or additional deductions will be 54650. So total research cost 102,000, and when this inner column calculation is added with this, the total taxable, so the total tax allowable amount will become 173,000, being primarily 102 qualifying straight away, and this 54,650 qualifying through additional amounts. And tax treatment, that the first requirement being addressed as told you by the manager or instructed you by the manager. The second requirement we will be doing is the amount of 1,000 charged to the statement of profit and loss in respect of this expenditure would be allowable for the purpose of calculating the taxable total profit. C, for the clog limited, it says, joint venture Q Limited, on 1st April 2020, I shall incorporate a new company, Q Limited. On that day, Q Limited will register for value add tax and begin to trade. It will develop a range of products over next few years. So it is a multi-dimensional product selling company. The planned ownership of the ordinary share capital of Q Limited is as follows. P Limited will be having 60%. Either Mr. Bem or either Mr. Bem or Mr. Bem's company BJB will be having 30%, and CX Limited will be having 10%. P, B, and CX Limited are UK resident company. Mr. Bem is resident in the UK. So all of these shareholders are being residing in UK. Just looking if there is any question. No questions yet. Okay, for Q Limited, what is the financial information given? I have calculated Q Limited budgeted tax adjusted trading loss. The manager has been using this information from the letter provided by Meta, and this has already been shared with you. And it says that tax adjusted trading losses for year ended 31st March 2021 will be 44,000. When calculating the loss, I deducted the whole of the cost attributable to this to scientific research amounting 102,000. Note 1, I also deducted 1,000 in respect of clock brand, and it will be amortized over the period of 35 years. If you could relate to that amortization of 4% thing, you must remember that an advantage there is, if the asset is of a very long life, then we will be disregarding the accounting treatment and be moving for 4% annually amortization thing. That will be very much beneficial, and apparently since this is being amortized for 35 years, it will be beneficial. So the scientific research costs are equipment and hardware cost is 27,500, material is 21,000, rent is 17,400, electricity and water 6,600, staff cost that is 29,500. So this 102 that we considered in the calculation is based upon these 5 components, and among those 5 components, one is the rental based thing that only qualifies for 65%. So we will be developing a workaround for this, as I have shown you in this calculation. You could see that total research cost, I have calculated that these total research costs are straight away qualifying, but for the additional expenditure I need to find I need to subtract this 35% disallowed amount, and then I calculate it like this. I hope it is clear. If there is any problem, please let me know. I am just doing it a little quick because I have lesser time and I have to complete this question, plus I need to refresh some exam technique points before the end of the session. So please bear with me. And if there is something not clear to you, you are requested to please raise the question. Okay, so the rent is an appropriate allocation of the rent payable for Q Limited premises for the year. All of the staff costs relate to employees of Q Limited, with the exception of 7,000 paid to an external contractor provided by an unconnected company. So all the staff costs 29,500. If all the staff costs were directly related to it, it would have been allowed. But since there are external contractors, so external contractors has a limitation that only 65% of such costs is allowed, so we will be deducting 35% of their cost, as we have deducted in the calculations I have shown you already. Note to purchase of the clock brand. On April 2020, Quad Limited will purchase the clock brand for £35,000. Advice will then be required on how to develop this brand through the use of social media. It is intended that Quad Limited will purchase this advice from the company based outside EU in a country where the VAT rate is 9% rather than the standard rated supplier from a VAT registered supplier based in UK. So telling you that your choices of the supplier and the applicable value added tax rates of that supplier. So the question in related to this, in relating to the brand, was explain the tax treatment of the proposed purchase of clock brand for 3,500. So what would be the proposed, what would be the tax treatment in this case? Can anybody enlighten me for that, please? Evelyn, Ravi, any of you guys who could please answer, what is the potential outcome of this question? How to answer this? The amount of 1,000 charge, higher of the cost and accounting amortization. Very nice. Failure good answer. The amount of 1,000 charged to the statement of profit and loss in this respect, in the respect of this expenditure, would be allowable for the purpose of calculating taxable trading profits. Alternatively, the purpose of calculating the company, for the purpose of calculating company's taxable trading profits, Quad Limited could elect to write off 1,400. If the amount was 35,000, when multiplied by 4%, it says that it is 1,400, which would clearly be beneficial, as Evelyn has mentioned. The higher of the cost in accounting amortization, you could see that this 1,400 is higher than actually what she did was 1,000. So we will be preferring 1,400 in this case. It is fairly a straightforward deal to crack here. Now, what was the third requirement in case of Q Limited? Calculate the amended budgeted tax adjusting trading loss for Quad Limited for the year ending 31st March, taking into the account. Now you could easily see that what she has done, she has made all the calculations by herself, including the full amount paid to the external contractor plus the wrong amount of amortization, maybe the lesser beneficial amount of the amortization. So we have to develop a rework of it. And how do we do that? We will be simply saying that budgeted tax adjusted trading loss, we are not going for any handsome calculation again by elaborating it and by doing it from the very scratch. We are not doing that. What we will be doing, that we have already seen that there were total budgeted trading loss of 44,000. The additional deduction we have already seen is 71,045. We added it there, and the amortization of the clock rent, $1,000 is already been taken, and we are going to take the difference, that is of 400. Have we added it, and very simply, in a very crisp manner, we have taken the account of things missed out by the client. I hope the guys with me have learned this art of doing the calculations very smartly and efficiently. See, we started from where she left and we posted the correct impact and we got the desired result out of it. Guys, are you with me? Clear on this? I will be winding up this question. Okay, Evelyn, thank you very much. I will be winding this question in next 5-10 minutes. And if there is anything that you want me to explain, I will be happy to do that. Other than that, we will be calling it a day. Once we are done with the question, and certain tips of the examination I give you will be repeated again. Okay, moving on to the next part. We are done with this. What does the next part say? So is it just Evelyn who's clear about the things, or the rest of the guys are also clear about the calculation, how to do the use of Excel and how to add the explanations and how not to indulge in those things that are not going to yield you any marks? For this calculation, we could have easily adopted that we started calculating it all over again. It would have wasted a lot of our time. But the smartest way was to take the impact of those, in fact, to take the correct impact of all those things that were not accounted for by the client. Okay, moving on. The next part, explain how much of Q Limited amended budgeted trading loss will be available for the use by Post Limited. So Post Limited is having 60% ownership, and what is the impact? They have the loss, obviously. So how this loss will be dealt? Post Limited will not be able to use the trading loss of Q Limited unless Q Limited is a consortium company. Had it been the consortium company, then it would have been easily taken into the account. Q Limited will be a consortium company if at least 75% of its ordinary shareholding is owned by the companies, each of which owns at least 5% but less than 75%. So the combination makes that consortium in which the single company is owning more than 5% but less than 75% of the total shareholding of that target company. Accordingly, for consortium relief to be available, BJB Limited must own 30% holding rather than Mr. Berm, because Mr. Berm, for Mr. Berm, it won't be qualifying for that. We need to have that company owning those shares. If there is any problem in the application of consortium, please let me know. The maximum amount which could be surrendered to Post Limited as consortium relief is the amount of loss into the percentage of shareholding. So 115445 as calculated above into the percentage of shareholding worth 60%, reflecting Post Limited holding of 60% in ordinary share capital of Q Limited. This will be available only and only if the consortium is made, because 60% on 60% there is no group for loss relief. That is formed when 75% shareholding is taken. There is no 75% shareholding there. So if you are not able to use the group for loss relief, then you go for the consortium. And when consortium is made, two or more companies are owning the shareholding in the pattern that every single company is holding more than 5% or equal to 5% but less than 75% of the shareholding. I will again open the questions. If there are any questions, please ask. Ravi, are you clear? Yes, Adisham, why not? See, we do not say that we get to 30% of the research and development expenditure relief. We say that the research and development expense, if it is qualifying, it is simply tax allowed expenditure. So that 100% of 230% is simply taken as an allowed expenditure. We do it and we just forget it. Now it comes to 130% extra. If you are a small and medium enterprise, you are able to get 130% extra on those research and development expenditures. And for those research and development expenditures, you have to make sure that all the expenditures are in line with the basic requirements. If any services are being taken through the contractual persons, only 65% of that cost is allowed, 35% is disallowed. We bifurcate those total expenses and we adjust them with those adjustments, and then the amount qualifying is taken as additional expense of 130%. This is how we do it. I hope it's clear. Okay, and I guess the last requirement for this Explain the value added tax implications of Q limited purchasing advice from the overseas supplier rather than one based in the UK. What are the benefits for this? That you are not engaging the supplier based in UK, but you are referring to the supplier based outside the UK where value added tax rate is 9%. Okay, we go to the answer. The provision of this advice will be business to business service. It will be treated as supplied in the UK because that is where Q Limited is established. Obviously, Q Limited will be required to pay VAT at the standard rate of 20% HMRC under the reverse charge principle. The rate of value added tax in the overseas country is irrelevant. That is the most important thing to know, that in such cases, whatever the rate of the foreign company or of the foreign company's home is offering is totally irrelevant. The input VAT can be reclaimed on this expense in the same way as any other input VAT you claim. Accordingly, Q Limited VAT position will be the same as if the services had been purchased from the UK supplier. So it means that simply there is no impact. Simply, whatever you treat for a UK supplier, you will be following that treatment. It is not going to limit or change the scope in that case. Okay, no questions as yet. So we move forward for RYB Limited. RYB Limited has explained why the profits at RYB Limited are subject to corporation tax. Let's see what acquisition of RYB Limited says. On 1st May 2020, P Limited will purchase the whole of the ordinary share capital of R Limited. For the purpose of UK tax, R Limited is resident in the UK. R Limited trade through the permanent establishment in the country of Tirona. See, R Limited is a permanent establishment in the country of Tirona. This is an important point in this case. R Limited budgeted taxable trading profit for the year ending 31st March 2021, all of which relates to its activities in Tirona is 75,000. So all the activities in Tirona of R Limited are resulting in the taxable trading profits of 75%, 75,000. These are the budgeted ones. Keep a note of that. R Limited has no other source of taxable income and is not expected to make any chargeable gains during the year. So this is the total income that you have to consider. Once we are confident of the profitability of the permanent establishment in Tirona, it is intended that RYB will establish PE in two other countries. So they have different plans that have been already shared, and it says that once we are confident of the profitability of the permanent establishment in Tirona, it is intended that they will be adding further further permanent establishments in two other countries. It says explain why the profits of R Limited are subject to UK corporation tax. Can anybody answer me? It is a fairly straightforward question. Guys, I need you to answer because of being a permanent establishment. Adhijam, elaborate it a little, please. Make me proud, buddy. Okay, great, because it is the UK company. P Limited is controlled in the UK. That's good. These are all the relevant points that can, uh, okay, assets or business owned by the UK companies will subject to corporation tax. That is good. That since it is a permanent establishment, so all of these things will be very good. Etisham, I am very much confident on the preparation of you guys. If you could do go an extra mile on the things you have already achieved, I believe that you guys can score really well in the examination. You just have to extend yourself to practice your questions by yourself to master the TX things. Okay, I will be recapping all those important exam technique points once I end the question, and then we will be ending this session today. Value added tax implication for purchasing. It is done for the C part. RIBE Limited is subject to corporation tax on the profit of its permanent establishment in Tirona because a B is not a separate legal entity, and UK resident companies are subject to the corporation tax on their worldwide income. This is the simple, crisp, crunch answer. UK corporation tax is 75,000 into 19%. Unilateral double tax 14% as mentioned. UK corporation tax liability is 3750 in this case that you have to pay. And what does the second part says? Let's go to that. And calculate RIBE Limited expected UK corporation tax liability. That is what we have calculated already. Discuss the advantages and disadvantages of R Limited making an election to exempt profits of its PE in Tirona from UK tax. So can anybody answer? This is again fairly a simple question. The advantage of making such election would be that the profits made in Tirona would not be subject to UK corporation tax. Based on the current rates, the corporation tax in two countries, this would save the corporation tax of 5%, as we have displayed in this calculation. That tax would have been saved if that election is made. However, it should be recognized that there would be no relief in the UK in the event of any losses being incurred in the trade in Tirona in the future. Once made, the election is irrevocable and would apply to all future permanent establishments of RYB Limited. Accordingly, there will be no relief in the UK for any loss incurred for any new overseas trade operated by RYB Limited. So it's general thing that if we are going to make the losses, we always operate as extension of the UK trade, so that the losses made overseas can be claimed back in the UK. But if we expect our operations to yield profits, we treat as a subsidiary, and the dividends, they are exempt. This is something that is being allowed by the tax legislation. However, such elections under question, if they are being made, they are irrevocable, and once they are done, the future risk and rewards will be associated, and we cannot simply maneuver them as per our wish. That advantage is. Kate, thank you very much. It was a very nice answer that corporation tax will be saved at 5%. Okay, guys, bingo. That is the end of the question. I have displayed how to attempt on Excel. There is no big deal in that. You simply can add the descriptions in one line and wrap the text, or maybe you could write the description in this way. This is purely dependent upon you. The examiner gives you the leverage to do that. Plus, if there are certain calculations that can be fairly simply dealt, you can add an inner column and an outer column for the higher level calculations. The outer column is used. For the smaller calculations, we use the inner column and bring the results under outer column. But if there are certain calculations that are being too long, we could simply add the working somewhere in the C sheet below or in front, and simply we say that, for example, total research cost working 1, and from working 1 we put it there, and the examiner could go simply to that working to ensure that the rules that were to be followed are actually followed or not. So guys, this is it. I hope this session has been fruitful for you, and we are done with today's session. The question thing. Now I will be trying to answer your question in next 5 to 6 minutes. If there are any specific questions you want to ask, and then I will be moving on some refresher of the exam technique, and then we could simply end the webinar. Uh, Effectively, the fifth day of this webinar to conclusion. Okay, Ravi, if you have trading loss for a sole trader and the loss is carried back to 3 years under extended carryback, if the business was to make a loss, Kate, sure, I'll be sharing my number. Okay, if the business was to make a loss in first 4 years. Okay, what an extended question, Ravi. I welcome you for more questions. Look, buddy, when it says FIFO method, I will be simply explaining you what FIFO method is. When you say you are going to offset in any loss in FIFO method, it means that in the case of opening years of loss, in the case of opening year of loss, the loss in the opening years is for the first 4 years of trade. See, if I say that in the second year of trade I make a loss, I can carry it back for 3 years. So as you have written, in those 3 years, the year coming in first. So if it was in 2019 and 2020, so in previous 3 years, 2016, 2017, 2018, 2019, 2019, 2020. So the first one coming in it would be dealt first, then the second, then the third, then the fourth. In this specific case, it is simple to do that because maybe there is some one or two streams of income coming, and you could simply calculate a tax refund and do it on the FIFO basis. Plus, the second part of your question, you say that you set it off against the current tax year. Whenever you do it against the total profits of the current year, and that is the Section 64 relief, not the opening years of loss relief. That is a specific separate section in which you were dealing, and the preservation of the personal allowance in that case was not allowed. I hope the question is answered. And for the answer for Kate, my number is this. The first one among those three will be the first tax year for the loss relief. The reason for choosing it is it would be fairly very easy to calculate the tax refunds and use them accordingly. Yeah, anyone else having any question? Okay, guys. You all have my number plus my email address, and I will be available on behalf of ACCA Global and Scan School of Accountancy for all of our students attempting the ATX examination. I would be very happy to answer your questions through email or maybe voice notes over the WhatsApp. But still not get your number, Fawad. There it is, buddy. I hope you get it now. So So everyone has the same question that you still not have my number. Now everyone, is it clear? You can't see my number. There you go, Jawad. I am replying to your answer. Tommy, thank you very much. You have been all of the students. They were exceptionally awesome, and I really enjoyed these sessions because of the presence you guys made. This session was not a one-way session. All of these sessions were not one-way session. Courtesy Ravi, courtesy Tommy, all of you guys, Evelyn, Fawad, Jawad, everybody was participating in the questions. They were asking the questions. They were telling me the topics to cover. So this was an overall very nice session to conclude, and I really enjoyed teaching you guys in this session. And I hope that you guys have learned potentially good points to score in the examination. Now, a quick reminder of some things that you have to remember. Number one is you don't rush into the answer. You Pleasure is all mine. I am humbled. Literally, I am humbled since all of you guys have been uh, you have been repeatedly joined the sessions. Nobody has skipped among. Okay, please speak my number. My number is 0092345850 00923458503804. I hope it is clear. Now, I will be quickly summing up the exam focus points. Number one is go through the opening paragraph. Number two is go through the requirements. Number three, first figure out the things that should be used in the exam in the question attempting, and you have to go through the things that are not going to be used in the exam. So do not engage yourself in anything that is not specifically being asked for. You have to be very much specific to all those things that the examiner is asking. You will only get the marks of the things that the examiner has asked you to do. Anything done by your side, any other calculation, any other explanation, it is not going to yield you a single mark. Secondly, when you are doing a computer based examination, there is a chance that you write a sentence, you simply backspace it, and you don't realize that the time spent in typing and the time spent in deleting that is actually being wasted. We do it in the normal conventional style on the paper. We write it, when we cut it, we see that we have wasted time on that. But on the examiner, but on the exam done on the computer, we do not realize, since we simply backspace it. Please consider it. Do not waste your time in writing one or two or three words, then backspacing them and then rewriting it from the beginning. First, construct the whole sentence in your mind, then you write it. You are no more a tax junior or a tax helper. You are a tax manager or a tax senior on whose advice big decisions, big financial decisions are going to be taken. So you should be very much clear about what you are writing. The communication should be effective. Whatever meaning you want to give to that conversation should be concluded in that effective manner for the person seeking for your advice. The advice should not be wavered, it should be clear in respect of the question that is being asked. Secondly, while practicing for the paper, you should know what pattern are you going to follow in the exam. Practice the papers for that 3 hours and 15 minutes for at least 2 times, so that the time management thing and that friendship with the computer based pattern is developed, and this is not your first time sitting on the paper and doing that experiment in the paper, where you are already left with nothing to lose. Again, the choice of questions is also very important. You should not attempt the question that you feel you are too good with. For example, if you think that trading losses, oh yes, it is my cup of tea, and you start doing it and you start doing it handsomely and wasting a lot of time on that, this is not at all good from your side. You have to attempt those questions that are going to yield you more marks, not those on which you are going to spend extra time. So select the questions on priority that pretty straightforward and that can be answered easily, shortly, and comprehensively. And then last but not the least, the meaning of the communication should be communicated to the end user. The end user should not be guessing what has been written. If the workings are done, they should be correctly referenced. The examiner does not have enough time to go through the whole Excel sheet and to find the notes you have written. They want some clear guidelines from you so that they could simply go what you have done, see, and they say bingo. The candidate is well equipped. Last point I am going to make, and then I'll be concluding the session. Please do not underestimate TX examination content. TX technical content, the course content of F6 is equally important as the course content of ATX. You cannot pass the exam simply on the knowledge acquired in P6 examination. P6 course content, you have to be very, very, very much clear about the concepts of tax, F6. That can be your trump card in the examination. That's it from my side. I hope that this session, this webinar conducted by ACCA and is going to help you go through your exam. I wish you very best of luck, and I am very thankful to ACCA for arranging this meeting for the students throughout the globe and giving me opportunity as a presenter to conclude. And I am humbled, I am humbled, I am humbled. My sincere and deepest praise for you guys that you excel, you exceed in the examination, and being a professional, you hold, you uphold the best standards as we are instructed through our ACCA. Further, one last tip, do not let go of the professional and ethics marks. They are the easiest marks, around 6 to 8 available in the examination. If you capitalize on them, your fight is for only 42 marks to do. So do not lose those marks. Value added tax should not at all be taken light. It is coming in different sections, either in income tax, either with corporation tax, or either with IHT, CGT. You have to be very much clear about the value added tax. Thank you very much, guys. If there is any question, I am available through email, and my WhatsApp number is with you. It was pleasure teaching you, and it was pleasure teaching you on behalf of ACCA Global and Scan School of Accountancy. This is your presenter, instructor for P6 examination, Shujauddin Malik, signing off from this presentation. Thank you very much and wish you very best of luck for the examination. May God be with you.